Okay, welcome back. And today we're going to finish, or in this lecture, we're going to finish talking about how to value something, about the sort of basics and the fundamentals of valuing, and what we care about in terms of the model that we use for valuing a company, and what it looks like. Okay, so we finished off last lecture, and we were comparing two different companies and talking about what the right set of cash flows should be, or what we should use, which set of cash flows we should use in order to calculate the value of these two different companies. And our first suggestion was to use earnings, or after-tax operating profit. And it turns out that that isn't a good measure, that isn't the appropriate cash flow to use to calculate value, and we talked about some reasons why. But the biggest reason why is that the measure of earnings doesn't actually capture the differences between these two companies. And so the question that we have to ask is, how can we improve our measure of value? What is a better set of cash flows to use? And the answer is, we have to find the set of cash flows that does capture this difference, the difference between these, the way that these two companies operate. Now we can see that company B is clearly better and thus should be more valuable than company A, even though they have the same earnings. And the reason is because you can see that company B has a higher return on invested capital. And because of that, they can reinvest less of their profit into the business and still enjoy the same growth rate in their profit. And we can see this relationship defined here in this formula. The formula that says that growth and profit is equal to the reinvestment in the firm times the rate of return, or the return on invested capital. So both of these companies are set up to have a 5% growth rate in profits, but we can see that company B invests half of what company A does, and that's simply because they have a return on investment that is twice what company A's is. So the way we improve our model, the way we improve our valuation, is to find the set of cash flows that accurately captures this difference, the difference between the company's return and reinvestment rate. And the set of cash flows, as someone intimated or intuited on in the last lecture, is free cash flows. Right? So that's here down at the bottom, where free cash flow is what's left over after the company reinvests and pays all its costs. Right? So without looking at the formula too specifically, we can say that free cash flow is equal to the operating profit minus the net reinvestment for the firm. And if we want to put that in sort of broader language, we can say that free cash flow is what's left over after the firm generates revenues from operations, pays all its costs and taxes from operations, and then chooses whether to use some of that profit in order to invest in either fixed or current assets. Whatever's left over after all of those things have been done in the current year is what we call free cash flow. That is, it's cash flow that can be used either to return profit to investors, or to it can be saved in terms of putting money towards future investment. Okay? This is the appropriate set of cash flows that we should use to value the business. Okay? So if we jump back to our simple value model, which simply says that value of anything is the present value of its future cash flows. Now we know that the appropriate set of future cash flows is what we call free cash flows. Okay? So we can plug in our free cash flows here. Again, make an assumption about the discount rate here. The discount rate is the risk of these cash flows, and we'll talk a lot more about that in the future. So we plug it in, we take the present value of each of these three cash flows, and we calculate the value of this business. Now, of course, this is just a simple example, and we hope that our company doesn't last just 3 years. And if it did, say, last 30 years or 40 years or 100 years or 200 years, calculating the valuation formula for 200 different changing free cash flows in the future would be tedious, and estimating what these future cash flows would be for 200 years is basically impossible. So luckily, we have some math tricks to help us out. And with a few assumptions being satisfied, we are able to collapse an infinite series of free cash flow present value problems, which is what we have here. Present value is the free cash flow divided by 1 plus the discount rate raised to the number of periods in the future. It is. If we have an infinite number of those and a few assumptions are satisfied, an infinite set of free cash flow present values can condense down into this problem, this model down at the very bottom that says that value is equal to the first free cash flow. Right? So value today is equal to the first free cash flow, that's next period's free cash flow, divided by the discount rate, which we're going to say is the weighted average cost of capital for the firm, minus the growth rate in the cash flows. And this should hopefully look a little bit familiar to you because it is the same structure as the growing perpetuity formula that you would have looked at when you valued stocks in your investments or your intro finance class. So this should look a lot like the stock growth model. Now, we can rewrite that here and say that the value of any firm at time period 0 today is equal to the next period, the first period's free cash flow, divided by the discount rate, which is WACC, minus the growth rate. Right? Now, the question for us is since we've identified the correct cash flow, is this a good enough model for us to use going forward? And to answer that, we have to really sort of dig deep and think about what the model's going on. In the first set, this model requires 3 pretty key assumptions. The first is that the growth rate in the cash flows is stable throughout time. What that means is if we say the growth rate in the firm's cash flows is 5%, that's never going to change over time. Every year they'll grow by 5% forever. Right? That's a pretty strong assumption to make, particularly when we don't even know, and here's assumption 2, particularly when we don't even know if the firm is actually going to last forever. I mean, in some ways we can say certainly it won't last forever. Of course it won't last forever. Nothing does, right? But we assume that it does, and we'll talk about this a little bit more later, but actually the assumption that the firm goes on forever is not that strong. The cash flows that are very far in the future, when we take the present value of those cash flows, they actually make a very small contribution to value. So assuming that the cash flows go on forever is actually a better assumption than trying to predict specifically when the firm is going to die and the cash flows stop. The other thing that we have to assume is that the risk of the firm is the same forever, where risk is the discount rate and the discount rate is the weighted average cost of capital. So if we assume that those 3 things are stable forever, and again, those are strong assumptions, then this model is relatively good. Okay? And unfortunately, there's not going to be a lot we can do in terms of getting around to those assumptions and making a better model without making it extremely complex or potentially too difficult to solve. Okay? But there may be some ways that we can improve the way that we think about this model. And so to think about those improvements, we got to think about the way that the implications that this model brings to value. So we'll do that just by thinking about how each component of the model affects value. So we'll say, what happens to value, to firm value in this model if free cash flows go up, right? So if the firm improves its operations and has additional free cash flows left over after all its costs and investment are accounted for, what should happen to value? Well, our answer is that it should improve value. And hopefully that's a pretty non-controversial statement on my part. That if the firm has more money left over after it invests all it needs to and pays all its costs, that's got to be a good thing, right? The second thing is, what happens if the weighted average cost of capital changes? Well, if WACC goes up, that means the firm is getting more risky and the discount rate is higher. In that case, we should expect that the value of the firm decreases. And in fact, that's precisely what we see in this model. If the cost of capital goes up and the risk of the firm and the firm's cash flows increase, we see that the value of the firm decreases. So we're 2 for 2. And last is, as growth goes up, what happens to value? And we'll see that if the firm's growth in cash flows go up, and you can see this, just play around with the math a little bit, but if G goes up here, the denominator gets smaller, and that means that value, the solution, gets larger. And so if the firm's growth rate in cash flows goes up, again, we should expect that the firm gets more valuable, and that's precisely what we see. Now, that being said, that doesn't mean this is a perfect model. In fact, there are some improvements that we can make to these measures that don't change the interpretation of the model, but they do help us catch some shady behavior that firms might engage in. For instance, free cash flow is not a perfect measure, and it's not perfect because it can be manipulated. The free cash flow measure can be manipulated, and we can see that in here. Free cash flows will go up for company B or company A if the firm invests less. If we do less reinvesting, we arbitrarily increase free cash flow, at least to start. Now, over time, the impact will be significant because we will have a lower growth in profit. But at least to start with, if we reinvest less in the business, we're going to have higher free cash flow. And that's not always a good thing. Secondly, we can affect the growth rate in cash flows, the growth rate in profit, by taking on negative NPV projects. In other words, I can generate more earnings by taking on bad projects, because bad projects, even if they're bad, they still will generate revenue. It just might be that the costs or the associated risk of those projects outweighs the benefit, but that doesn't mean that they won't arbitrarily raise revenues and they won't arbitrarily raise the growth rate in cash flows. So there is some ways that we can rearrange this formula so that we make it obvious if managers undertake some of these behaviors in order to raise value or distort value unfairly.